The control of the assets or the property happens through the trustee, which you would appoint yourself. That gives you the ability to control or do what you want with the real estate, gain the benefits of the outcome as a beneficiary of the trust, but not have the real estate in your own name. There are advantages to this. One such thing is that the debt is not in your own name. So when you apply for a loan in the future, you can honestly say that you have no debt in your own personal name. This means that you can use your income multiple times using this structure in order to purchase more and more real estate, propagating yourself faster. Hey guys, and welcome back to another installment with the Ugly Investor. I'm going to have to firstly apologize for being away for a week. I have come down with the Roni-19, which has affected my voice and my ability to speak clearly and coherently. But today is an exciting day. We're going to talk about structures, or specifically the 4 types of investing structures that you can use to purchase real estate in Australia. Now, I'm not sure what the rules are internationally, but I imagine that there are similar structures across the pond for any of the other international viewers that are on this call. So just bear that in mind and talk to your own accountants and legal team regarding how these might affect your ability to progress moving forward. So before we jump in, just a quick disclaimer. Look, I'm not a financial advisor. Under the Australian law, I can't provide any specific financial advice. So the information provided here is for entertainment purposes and educational purposes only. The content that I'm providing doesn't constitute any specific financial advice for your specific circumstances. So I encourage you to seek and talk to professional financial services such as legal or accounting teams or anybody else that will understand your circumstances better than I will. Now that is over and done with, let's jump in to the 4 types of investing structures. Now, so look, there are 4 primary types of investing structures that you can use to purchase real estate in Australia. The first one is the individual. That's you personally. It's really quite simple. If you want to purchase something, you sign on the dotted line. So long as you have the approval and the finances to back yourself, you're done. It's that simple. It's not particularly complex. It's the simplest form or structure that you can use to purchase real estate in Australia. The next form or structure that you can use is a partnership. And that is typically when 2 people get together, they form a partnership. You would use a partnership agreement in order to set the boundaries as to which the partnership operated. So that includes things like how much people put in and how much people get back from the transaction or investment that people purchase, either an income base or profit base. So that's all fleshed out in the partnership agreement. So one of the big advantages of a partnership over the individual is that you can pool resources together. And those resources allow you to progress into larger deals faster, or even get into the property market earlier than you would if you were doing it by yourself and you had to save up a bigger deposit. The third option is trusts. Now, trusts themselves act on behalf of something. Whether that something is a company or an individual, they act on behalf of the best interests of that entity. For the purposes of trusts for property investing, we're going to assume that it acts on behalf of a shelf company. That means that the company which you would be director of would have a trust that purchases real estate on behalf of that company. The big advantage of trusts is it breaks ownership and allows you to spread income across your family, specifically with a discretionary family trust, to maximize your tax benefits or tax situation with the Australian government at the end of the financial year. The last investing structure that you can use is a company. Fairly straightforward, very easy to set up, but it has high initial costs. You have to maintain the company through ASIC, which is a $300 per year fee just to keep the company registered. And you have to have financial statements and tax returns prepared each year for each of those company entities. Right, so these are the four main investing structures that you can use to purchase real estate in the Australian market. You can also use a combination of the four in order to help propagate yourself further along your journey. Having had a look very briefly at those four types of basic investing structures that you can use, which one is right for you? And it's not a one-size-fits-all answer. Everybody's circumstance is different, and therefore the outcome or the output or the investing structure that you use is going to be different based on your financial and personal needs. But you should start by asking yourself a series of questions. Most commonly, the questions you want to consider are, how long are you planning on owning the investment for? Is it a short-term deal or a long-term deal? Is the asset that you're purchasing going to be an income-based asset that provides you a perpetual return for life? Or is it a value-based deal, something that you're planning on creating additional value and flipping back into the market to turn a cash profit? Do you expect any cash flow loss from the purchase of this asset? In which case, would you consider having that loss offset against your personal income, therefore getting a tax benefit against your own salary? Who do you want to receive the income from the asset? Will you need to protect the asset from potential creditors due to you having a risky job, such as doctor, lawyer, builder, something where somebody might be able to sue or form litigation against you personally? What are the tax implications of the deal themselves? Are you looking to purchase assets in different states, and therefore land tax may be a consideration that you have to take on board? How quickly do you wish to own the next asset? And more importantly than all the previous questions that have been asked is, what are your long-term financial goals and plans? You should have a good hard look and think about what it is that you want to achieve long-term for your financial journey and success, and then break down what you need in the short term in order to achieve that. It's a mistake that I personally made, setting up the incorrect structures, and it cost me more than 100 grand to undo that mistake and reset myself up again. It was worth doing for me personally, and this is one of the reasons why I'm trying to get that information out there so that you can find out which structure is better for you moving forward. Let's take a quick look at what the pros and cons of each are. When we take a look at the individual, there's no setup costs. It does not cost you anything to purchase a property in your own name. You just have to sign on the dotted line. There's low maintenance costs. When it comes to doing your financial tax return at the end of the year, it doesn't cost you any extra. There's very little additional work that you have to put in order to maintain that asset in your own name from a cost-based perspective. You gain access to the 50% capital gains tax if you were to hold the property for more than 12 months and decided to on-sell it later. And if you purchase the property as a principal place of residence, then you get 0% capital gains tax applied if you sell the property in the future. Purchasing the asset as an individual can also offset any cash flow loss against your personal income. For example, if you purchase a negatively geared piece of real estate which costs you 10 grand to hold, you could take that 10 grand off your personal income and pay a reduced tax to the government. Effectively, what you're doing is you're losing 10 grand to save yourself 3, as you would claim that 3 grand back through tax incentives that the government makes available to you. You can also access the land tax free threshold for each state of Australia. Some of the cons of the individual, however, are there's no asset protection. So if you're sued because you work in a high-risk industry, there is no distinction of ownership between you and the real estate, which means that if a litigation occurred, there is a high likely chance that they can also come after the investments that you purchase under your own name. An additional negative is that there's no way to split the income. If you purchase something in your own name, any income you get comes back into your own name. If it pushes you into a higher personal tax bracket, you have to pay more tax on it. That's just the way that it is. There's also no ability to leverage borrowing capacity, as you are personally restricted by your available income to service debt. Each individual has a maximum capacity to service debt based on three things: how many assets you have, how many liabilities you have, and how much income you have. Income is the highest determining factor of your borrowing capacity. And if you eat into that by purchasing an asset, your maximum borrow capacity decreases, limiting your purchasing ability in the future. For a partnership, it's very similar to the individual. You get everything that we spoke about in the pros, except some small differences. The first notable difference is you can leverage the skills and experience plus the money of your partner that you choose in order to go into the deal. If they bring something that you don't have to the table, you get to leverage that skill set in order to propagate your investing success faster. Another advantage is you have potentially two sources of income that allow you to increase your borrowing capacity, meaning you can get into the property market much faster and earlier than you otherwise would. In fact, I started with partnerships in order to get myself going. One of the disadvantages of partnerships, though, is that you have to run every decision by the partner. It's only fair that they have an equal share in the decision-making processes that go forward. However, if two people diverge in their financial paths and their plans for the future, it becomes very difficult to stay aligned. So partnerships are a great opportunity to get started, but it's something you eventually want to get out of so that you can make your own decisions to best influence and help your own family situation. One thing to note is there is a slightly increased cost in setting up partnerships than there is for the individual. And that's because for a good partnership, you would have a partnership agreement that would specify the very clear inputs and outputs of the individuals for that agreement. How much money each people are putting in from a percentage perspective and how much they get out of the deal from an income and profit perspective. Some of the other cons that are involved with partnerships is there's still no flexibility to split the income to maximize against your own individual circumstances. If you're in partnership with somebody outside of the family unit, it doesn't give you much ability to split the income to low income earners to maximize your tax situation within your own family. Another disadvantage is banks don't look favorably to different partnerships with different properties. So if you establish a partnership, it's best to maintain that partnership moving forward. As soon as you want to bring a different partner in for a different project, the banks look very negatively on all previous partnerships when it comes to borrowing capacity. They assume the previous partners are not going to be able to service their side of the loan, making you solely responsible for 100% of the debt, even though you're only entitled to, let's say, 50% of the income, which can make it very difficult to continue to grow from a capacity perspective. The third option for investing structures is trusts. Now, as stated before, trusts act on behalf of an entity. That means that you have the maximum asset protection as ownership of the real estate and control of that real estate are separated. The trust itself owns the real estate on behalf of a company or a shelf company. The trust itself owns real estate on behalf of a company. And the control of that trust happens through you. The control of the assets or the property happens through the trustee, which you would appoint yourself. That gives you the ability to control or do what you want with the real estate, gain the benefits of the outcome as a beneficiary of the trust, but not have the real estate in your own name. There are advantages to this. One such thing is that the debt is not in your own name. So when you apply for a loan in the future, you can honestly say that you have no debt in your own personal name. This means that you can use your income multiple times using this structure in order to purchase more and more real estate, propagating yourself faster. It should be noted though, that the more real estate you purchase, the more natural risk you induce into your portfolio, as you have a larger amount of debt, which gives you a larger exposure to economic and market fluctuations. Some more pros for the trusts also include the 50% capital gains tax exemption. You are entitled to receive the 50% capital gains tax so long as the trust itself holds the real estate for more than 12 months and the sale of that property is for the beneficiary of an individual only. A wonderful reason that people use trusts to purchase real estate is the discretionary ability of the trustee to appoint the beneficiaries the income as they choose fit, which means that if you had a high income spouse and a low income spouse, you would put all of the income towards the low income spouse, reducing the effective tax that that person would pay. Your unit would gain a larger amount of income for that financial year. There are cons to setting up trusts. As wonderful as some of the examples I've given you, they are expensive to set up. And ideally, you want to set up a corporate trustee with a family trust associated with it, giving you more flexibility in order to determine where the income goes based on your investing asset. The maintenance costs are high. You have tax returns, financial statements that you have to produce for each entity that is set up in order to create the trust structure for you to purchase the real estate. Because you want to set up a shelf company for the family discretionary trust to act on behalf of, you will also need to pay an ASIC fee to maintain the company as registered year on year, which is roughly $300. Maintenance costs are higher because you have to produce tax returns and financial statements for each of the entities. You can also not distribute cash flow losses to offset personal income using a trust. Whereas with the individual or the partnership, if the investment made a loss, you can claim that against your personal income. You can't do that with a trust. Trust laws are also complex and they're subject to government changes all the time. So you do need to have a very good team surrounding you in order to understand the implications of owning a trust in the current environment. And another negative of owning real estate in trusts is there is no land tax free threshold for most states in Australia, which means that if you were to purchase something, say in New South Wales, land tax would apply at $0 onwards, which you would otherwise get a benefit for the individual or the partnership. Let's take a look at the last one, the company. When choosing to use a company to purchase real estate, it provides excellent asset protection because the company itself owns the assets and not you. The directors control the assets, which you would be one of. Another advantage of the companies is that there is a maximum tax rate of 30%. No matter how much income the company produces, only 30% of it can be taxed. This is quite key because as your income grows, you want to make sure that you don't pay more than 30%. Any income that would otherwise additionally be paid above 30% can be put into the company to keep your tax rate at a maximum of 30%, which is very handy. You can still split income with companies. It's a little bit more tricky though, because you have to disperse income as shares or dividends. Those dividends are provided to the shareholders. The shareholders' stake in the company is determining how much shares are being split. Another advantage of owning assets in a company is that the debt is in the name of the company and the directors of the company go guarantor for the debt. The director's income, just like the trust situation, can be used multiple times. So long as you have the deposit to be able to purchase real estate, you can go to different financial institutions, providing yourself as a guarantor, being a director of the company, in order to purchase the assets for the companies. This means you can purchase more and more real estate because you are not limited to your personal income's capability of borrowing capacity. Another fantastic advantage that companies provide is they have an individual land tax free threshold. This means that you get the benefits of not having to pay land tax from $0 when you set up and establish a company. There are cons to owning companies though. They're expensive to set up, but they're very easy to do. They have maintenance costs similar to the trusts, where you need to have financial statements and tax returns prepared for each year. You also need to have that assets compliance cost paid every year, another $300. You cannot distribute cash flow losses to offset your personal income. However, you can hold the cash flow loss in the company and then use that in the next year when you gain a cash flow positive result. It's not eligible for the capital gains tax discount, which means that if you were to sell a real estate in a company, it costs you more. So long as you held the property for more than 12 months, it's going to cost you more in tax to sell the property than you would if you were to sell it through a trust, an individual, or a partnership. And one of the biggest cons of a company is it's incredibly difficult to get residential loans through. Is it impossible? No, it's not. You need to have a good broker and a good team and a good understanding of the systems in order to get them across the line. However, most financial institutions want to see companies pay commercial loans either at 60 or 70% LVR. Where with individuals, partnerships, and trusts, it's much easier to get 80 or 90% LVR, meaning it's greater access to the same real estate. Companies often have to provide a 70% or 60% LVR, or a maximum 80% LVR, meaning you need to have more personal cash available in order to subsidize the purchase of the real estate. The last thing that you need to know is that you can have a combination of these structures in order to purchase real estate. The combinations are quite interesting. So I'm just going to run you through what a typical trust structure would look like. You would start with a shelf company, as you see here. The shelf company owns a family trust, or in this case, the family trust acts on behalf of the shelf company. The trust itself purchases real estate, and when it purchases real estate, any income or profit it makes is distributed to the beneficiaries, you, the individual. When it comes to a combination that's quite common, you would add a investing company underneath the family trust, as you can see here on the right. What this means is that the investing company itself makes the asset purchases in its name. In order to distribute it, you would pay your shareholders of the investing company, which is your family trust, 100%, a fully franked dividend, and then your family trust has the discretionary ability to distribute its earnings towards your family. So you lose no disadvantages in the ability to spread the income as if you were just a standard company alone. These are some of the combinations that you can use to purchase entities in. There are many more combinations, and I might show you some of them on another video. But for the moment, I'm trying to keep it simple. To close out, what I've done is I provided a spider chart here with some of the advantages and disadvantages with each of the 5 investing structures that you can use to purchase real estate. Either the individual, the partnership, the trust, the company, or a combination of those 4. If you're to take a look at it in summary, the individual and partnership has the best scores for the establishment and maintenance costs. They do not cost much other than what you would already be paying throughout a financial tax year. However, trust companies, or a combination of them, would cost significantly more. Every time you set up a structure, it costs money. Every time you wish to add an additional structure, it costs more money per year to maintain. So your assets need to produce income that offsets the cost of these structures per year in order for them to have a financial benefit in the short term. Not the long term, the short term. From a borrowing capacity perspective, trusts, companies, and combinations of those have the greatest ability to get the most amount of borrowing leverage that there are in the marketplace. So bear that in mind when trying to purchase multiple pieces of real estate. You may want to consider trust companies or a combination of them. From a land tax perspective, the best structure you can use is a company or a combination that uses a company to purchase the entity, because every company you set up gets its own land tax free threshold. So you can set up a company, purchase an asset, set up a separate company, purchase a separate asset, and continue the process. From an asset protection perspective, trusts by far are the best outcome for it. And if you use the combination with the trust structure in it, this provides that same level of maximum asset protection. If anything was to go wrong, you won't lose the assets. You would lose anything that's in your personal name only. I really appreciate that you've taken the time to come to the end of this video. I know it's a little bit of a long one, but it's well worth the information. Make sure you speak to your financial accountant and legal team or any other financial advisors that you have in your team. They're going to provide you with invaluable information, and they will know your personal circumstance far better than I will. Bear the information in mind for the next time. If you liked the content, hit that like and subscribe button. It means a lot to me, and I appreciate that you've gotten this far. We'll see you on the next one. Thanks, guys.